We all know what foreign exchange is, buying one currency and selling another. But the moment someone says FX swap, it suddenly sounds far more complicated than it really is. So in this video, I want to explain what an FX swap actually is, why people use it, how it works in real life, and what the costs look like, in a way that you can follow even if you're not working on a trading desk. So let's start with the basics. An FX swap is simply two linked FX trades. Both trades are agreed today. One settles on a near date, so T+1 or T+2, and the other settles on a pre-agreed date in the future. In the first trade, which people call the near leg, I give you one currency and you give me another. In the second trade, the far leg, we reverse the exchange and go back to where we started. Now the important point is this. The base currency amount is the same in both legs, but the counter currency amount differs slightly due to forward points. We're not changing the base amount, we're just swapping it and then swapping it back at a slightly different rate. Now, why would anyone want to do that? Well, in practice, FX swaps are used mainly for short-term funding and liquidity management. So here's a very simple example. Imagine I'm a European bank and most of my cash is in euros. Tomorrow I need US dollars, maybe to settle a trade or fund a client position. I don't want to buy dollars outright because, well, that would give me FX exposure and I'd need to convert it back later at an unknown future rate, creating FX risk. So instead, I enter into an FX swap. In the near leg, I swap 100 million euros and receive $108 million at today's spot rate of 1.08. Then, 1 month later, we reverse it. I give back the dollars and I get my euros back. But in the far leg, I don't give back exactly $108 million. I give back slightly more, say $108.162 million. Now that small difference comes from the forward points, the difference between the near leg rate and the far leg rate. Now those forward points simply reflect the interest rate differential between the two currencies over the 1 month period, which neatly brings us onto pricing. Now an FX swap isn't quoted as a single FX rate. Traders quote the spot rate plus or minus a set of forward points. Now those forward points are determined by the interest rate differential between the two currencies, a relationship known as covered interest parity. Now here's the key thing depending on the interest rate differential. If the interest rate of the base currency, in this case euros, is lower than the interest rate of the counter currency, in this example US dollars, the market needs to compensate you for lending the lower yielding currency. This compensation is paid to the hold of the lower yielding currency, meaning it trades at a premium in the forward market. For euro dollar, this means the forward points are positive added to the spot, and the forward rate is higher than the spot rate. If the base currency interest rate is higher, the currency trades at a discount, meaning the forward points are negative, i.e. subtracted from spot, and the forward rate is lower. It's just a way of compensating whoever is lending the higher yielding currency. So let's put some numbers on it so it feels more real. Imagine the spot euro dollar rate is 1.08. The 1 month US dollar rate is 4.8% and the 1 month euro rate is 3%. That's a 1.8% interest rate differential in the favor of dollars. Now over 30 days, that works out to be approximately 0.00162 forward points. Now because dollar rates are higher, the forward points are positive, so the far leg rate becomes 1.08162 instead of 1.08. Now in cash terms, that means today I agree to receive $108 million and I give you 100 million euros, both settling on the spot date 2 business days from now. 1 month later, I give back $108,162,000 and receive my 100 million euros back. That extra $162,000 is simply the implied funding cost of having borrowed dollars for a month. It's not a gain, not a loss, it's just the economics of the interest rate differential. Now, a couple of quick terms you may also hear. A Tom next swap is where the near leg settles tomorrow, so T+1, and the far leg settles on the spot date T+2. An overnight swap settles today and reverses tomorrow. Banks use both of these every single day to manage very short-term funding and intraday liquidity. So to put it all together, an FX swap is two back-to-back FX trades, both agreed today, one near-dated and one far-dated, that allow you to borrow one currency and lend another without taking FX risk. The price difference between the two legs reflects the interest rate differential, and the bank spread is typically embedded in the forward points quoted. It's one of the fundamental tools used by banks, asset managers, and corporates to manage short-term funding and currency liquidity. In fact, FX swaps are the largest component of the FX market in terms of daily turnover. And if you ever want an easy way to explain it to someone else, you can say it's like borrowing dollars and using euros as collateral, and then reversing the exchange later at a rate we agree upfront. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.